Hi, my name's Colin Fox. I'm a Senior Financial Planner with Hudson Financial Planning. We're here today to chat about the Division 296. Essentially, this is a tax for members of super balances over $3 million. It's an additional 15%. It's important to note it's not yet legislated. Parliament's due to meet in August. Potentially it will get through. Labor just needs the Greens at the moment to push this one through, but it's not legislated. It may then be backdated to 1 July 2025. What this means is there is time. If people do find that it's suitable to withdraw, you've got until 30 June 2026. This is where we come in. So our clients are concerned about this additional tax and how it applies to them. So we look at things that they need to consider. At the moment it's not indexed, so it might apply to more people in the future. So some considerations include, well, if there is a tax that's levied, what is that? What is that amount? Then you need to have provision within your super fund or externally for those funds. The tax liability itself is not added to your income tax as a personal individual or even the self-managed super funds tax. It's external to those. What this means is that it can be paid either personally or from super. Irrespective of your age, you can pay the tax from super. So it's important to know what that figure might be and have provisions. Really important for those members that have illiquid assets such as investment properties. If the plan's to get the funds from super, then it's important to know you've got the capital available. So we look at, well, what are the options? You can withdraw. We advocate at this point in time, it's not legislated unless there's a compelling reason that an accountant and advisor has suggested this is the right way to go. We would say just wait and see. A compelling reason could be tax in your personal name is tax-free up until $18,200 in earned income. So some of our clients do have some capital that is outside of super to take advantage of that tax-free income tax bracket. Importantly, it's critical that people calculate capital gains tax. If your fund is in the accumulation phase or part of it, tax will apply at up to 15%. This means that you need to consider what did you buy the asset for, what might you sell it for to get the funds out, and are you looking at a large capital gains tax bill? You could inadvertently pay a lot more tax by withdrawing funds rather than leaving it there in the first place. Then you need to consider, well, if you've got the funds outside of super, where do you invest? Your personal name, as we discussed, you need to consider, do you meet a condition of release to get the funds out? If you're 60 and you're retired or you're aged over 65, you can withdraw from super. If you've met one of those conditions of release, some of your super potentially should already be in a tax-free account-based pension. If it isn't, that's a key area to look at quite soon. So if you withdraw it, you can consider things such as a family trust if beneficiaries are on lower tax brackets, adult kids as an example. You can consider a growth bond. They're internally taxed at a maximum of 30%, often lower when imputation credits are factored in. They are a deferred tax scheme as well, so after 10 years you can sell a growth bond tax-free. Importantly, we look at the conversations we have with clients now are about intergenerational wealth transfer. So people can hold funds within super until they die and pass it on. Some of those proceeds will be taxed at up to 15% to non-adult dependents. Alternatively, you can look at withdrawing from super sooner, helping the kids with education or grandkids with education, paying off some of their debt, and actually seeing the benefits of that inheritance provided to your kids while you're still around. It's important to know and do some numbers around if you do provide a certain amount to your children, do you still have enough for your personal lifestyle goals? The tax at the moment is quite interesting. It's applied on assets that are not sold, so it's not a normal type of tax. Essentially what will happen is the ATO in July 2026 will assess if you've got more than 3 million in super. If you do, they'll look at what your earnings are over that time. So just say as an example, you've got 6 million in super. You're 3 million over that maximum that you can have. So they'll look at what percentage is over that maximum. If you've got 6 million, you're 3 million over. So you've got 50% over that maximum. Then what happens is tax is applied to the earnings of that super fund. So with the 6 million example, let's just say it started at 5. Contributions and withdrawals do impact this, but let's remove those to make it simple for now. If it started at 5 million at the start of the financial year and ended at 6, they'll say your notional earnings is $1 million. Then they'll say, well, only 50% of that applies because you're only 50% over. So $500,000 is your notional earnings. They'll then apply tax on that at 15%, which is $75,000. So that sort of analysis is really important to understand what your upcoming liabilities are, and also looking at, well, can you do better outside of that superannuation environment? This is where we come in. So we wouldn't advocate any change until you've seen a qualified professional such as ourselves to look at what your options are outside of super, within super, what are the tax consequences, and start that conversation on intergenerational wealth transfer. If that's something that's important to you and you'd like to chat further, please reach out to us. Bye for now.